Gold prices have been on a tear since the start of this year. It is one of the few asset classes which have shown positive returns for this year. Gold is up almost 30% since the beginning of 2025. We at Muffet Investments have been long-term bulls on gold. Please see our previous videos. We also have had some great calls on gold on LinkedIn. On 25th March we said, we think that price is headed towards a key algorithmic target of $3,046. As long as price is supported by the 4-hour FEG, we will look for longs to target $3,046. Also 2830 line is the key support. If price breaks this, then gold becomes bearish on a weekly basis. On 28th March we said that so as long as price stays above the small shaded area at the top, we can look longs to take out the liquidity residing above the highs. After that, if price continues higher, then gold has potential to go to $3,140 to $3,170. On 9th April, just before the big move in gold, we pointed this out. See the accumulation in gold at the weekly FEG. This suggests a big move ahead. If we can have close above 30.32, then it is likely that we are in for a big move up. We are already long on gold at lower levels. Let's have a look at current prices of gold. Here is a 4-hour chart of gold. We use market maker models in our technical analysis. We have identified 2 support zones in the blue. We are currently bullish on gold from a fundamental viewpoint, so we will be looking to take longs on gold to target all-time highs. The prices have made equal lows above a support zone. Next week, we will look to see if a raid of the equal low happens followed by strength in the prices. If that were to happen, then we will look for longs with stops below the support zone. If on the other hand, the price fails support, then we wait for the lower support in the region of $3,160 to $3,130. This in our view the best place to initiate new longs with stops below the support at around $3,115. If the price goes below the second line support, then price will take out liquidity residing below $2,980. So as long as price is above the support zone, we only look for longs. From a fundamental standpoint, there are many factors driving the price of gold. The main driver is the devaluation of the dollar or loss of purchasing power of the dollar. The other factors include central bank buying of gold and President Biden's stupid decision to weaponize the dollar after the Russian invasion of Ukraine, accelerated this as it reduced the overall trust in the dollar as a reserve currency. It meant that at any point of time, the US might seize other people's asset if their views are not in alignment with the West. One of the underrated reasons in our view is China's effort to replace the dollar with a gold-backed alternative. Already, the dollar's reserve status is being undermined by China by using renminbi for transaction between the Gulf states and China, and between China and Russia. We however think that the primary reason for the rise in gold is the unsustainable debt load of all major economies of G7 and China, with the exception of Germany. The market implicitly senses this and thinks that there will be reset where all the currencies will be devalued against gold to reduce the overall debt burden of the government. There needs to be a fundamental reset, and gold is one way of reducing their obligation by devaluing the currencies against gold. The alternative would be default, which would not be politically popular. The official debt to GDP figures do not take into consideration the unfunded pension and healthcare liabilities. For example, the official debt to GDP figure for the United Kingdom is not £3.8 trillion, but will stand at £12 trillion, which is 400% of GDP. We think that there are 2 ways of using gold to reduce debt. The first is to monetize the gold reserves on the balance sheet. For example, the USA has 8,000 tons of gold, which is valued at $40. If this could be revalued at current prices, it would give the US government an extra $1 trillion. The second way is to issue long-dated bonds, backed by gold at much lower interest rates. This would reduce the overall interest burden on the debt. We think that the US government would opt to use both of these ways to reduce debt. We also think that the Chinese government will devalue its currency against gold to reduce its debt burden. We also think that the Chinese government is accumulating gold to try and replace the US dollar with a gold-backed currency, possibly a gold-backed Hong Kong dollar. All these scenarios means that we will see continued rise in the gold prices. We think the move is only getting started. Why do we think that gold may be a big part of the reset? We will showcase some of Scott Bessent's speeches to get clues.
It was unclear whether we were going to exempt gold from tariffs, which I believe we have. And look, that there are a lot of different stores of value over time. Bitcoin's becoming a store of value. Gold has historically been a store of value. I think what's interesting is, where do we see the gold demand coming from? A huge amount is from China. There are 1.4 billion Chinese who all want to get their money out, and they won't let them. They will let them buy gold.
He believes in gold as a store of value. He also points out the Chinese demand for gold, and in particular the Chinese government steering its people to buy gold. The fact that the Chinese government is encouraging its citizens to buy gold suggests that the Chinese government is in the process of creating a gold-backed reserve currency. The following is just our views and speculation, and may or may not happen. We speculate that the US is planning to issue gold-backed bonds, and the US allies will be forced to buy these bonds at low rates in return for preferential trade deals and security guarantees. We also speculate that the US is accumulating gold, which explains the big rise in gold and the fact that there are no tariffs on gold. We also think that China is accumulating gold to back its own reserve currency, which will be used for trade within the China bloc. As we said earlier, both blocs will devalue their currency against gold to reduce their debt. Over the long term, gold has close correlation with the M2 money supply. However, there are periods where gold moves up aggressively. These are during the rate-cutting cycles. Here we compare gold prices with the 2-year yields, which closely follows the Fed funds rate. Over the last 20 years, all the rate-cutting cycles once started resulted in Fed funds rate going below 1%. It is during these times that parabolic movements in gold happen. So as long as rates are above 1%, we think that gold will find support and continue to increase. We hope you liked this video. For more of these, please like and subscribe to Muffet Investments.